Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On the show tonight, I want to look at how you play these strange days in the market right now. I've been saying to lots of people, three eyes are threatening the market: Israel, Iran and inflation. But in many ways, provided the expectation happens, namely interest rates fall, it could be a really interesting way to make money. And then I'll talk to June Bailu of Tribeca Alpha Plus. June Bailu's got a number of interesting stocks she's looking at right now, some new ones, one in particular which is very new, and she wants to share that with us. But before then, let me give you my take on what you should be thinking about these strange days indeed on the stock market. So when I was sitting down yesterday to write my Switzer report piece for Monday, I couldn't help but thinking about the way the market sold off big time on Friday. It was a bad market week for Aussie shares and particularly Wall Street as well. And then on today, Monday, the market has rebounded, and this John Lennon song kept coming back to me. Nobody told me there would be days like these. And I'm sure lots of investors had that sort of feeling. One of the lines from that song also is strange days indeed. And that's what we're trading through, strange days indeed. But I do really think there's actually a clue in what's going on right now, a clue we get from the past, which we can use to make money in the future. So let me just recap on why things are going so badly now. I've been putting it down to three I's: Israel, Iran, and inflation. And ironically, at the moment, Iran and Israel, I think, have captured the fear factor in the market to explain why there's been a sell-off. And let me tell you this, I did something very unusual yesterday. I got up on a Sunday, and it's a day which I really don't really pursue news. So of course I look for sporting results, but not news. I do that 6 days a week. I want to relax on Sunday. But I knew that if Iran reacted badly to Israel's bombing of Isfahan, I hope my pronunciation is right, that could lead to more negativity for the market. And I was really happy to hear that the foreign minister of Iran looked at the drone attack and basically compared it to the toys that his children might play with. And it kind of implied that Iran wasn't going to get up and start reacting badly to what's happened. And I think that's part of the reason why the market's done well today. So we are living through strange days indeed. But behind all this is the fear around inflation. That's probably the biggest depressor on the markets, if such a word exists. Israel and Iran are creating short-term fear factors, and they're important, but the underlying fear is, will interest rates be cut in the US, or could they even rise? I don't think they will rise at all, but it certainly explains why there's been a big negative reaction last week. And happily we're seeing a positive one, but it's not to the same magnitude of the sell-off, and I think that's partly the reason for that is there's still this inflation fear going on. Now, of course, the markets will be on tenterhooks for quite some time until they work out, is this Middle East encounter conflict going to get worse? If it sort of dissipates and it's still there but becomes like a Ukraine-Russian war, something that's going on, but it's not going to involve potentially America getting involved and other Islamic states, well then the market will probably learn to deal with it. Historically, it has. If you look at two of the biggest sell-offs around geopolitical events for the US in recent times, well, not really all that recent, in 1990 when Kuwait was invaded by Iraq and America came in to take on Iraq, the market really did sell off a big time and was down for quite a while. But this also coincided with a US recession. Recession here as well. Our recession was really bad. Unemployment got to 10.4%. And the next big geopolitical event which affected the market for a longish period of time was September 11, and that was around 2001. And also that was around the dot-com crash. So another US recession coinciding with geopolitical events. So the big sell-off wasn't all geopolitical fears. It was also recessions, and they really do smack stock markets. At the moment, there's no expectation that the US is heading for a recession. In fact, their problem is they're growing too quickly. So I just think that if this Middle East thing becomes manageable, the focus then flicks over to inflation in the US, so watching those data drops, two really important ones this week, economic growth on Thursday, and the personal consumption expenditure reading. This is the inflation reading that the Fed thinks is really, really important. And that's going to be an important assessment factor for whether stocks should go up or go down or whatever. So that's going to be important for this week. And at the same time, keep our fingers crossed that the Middle East issues become less of a problem. So putting it all together then, how do you invest in this environment? One of the most interesting guys in the US economic scene is Professor Jeremy Siegel, the Wharton School professor at the University of Pennsylvania. Now, Siegel is often on CNBC. I've been watching him for decades. Really smart guy. If I'm looking for a leg up to what might go on in the US, and particularly the markets, he's an economist who actually understands the market. He's saying at the moment, they're sort of saying, well, at the beginning of the year, they thought 7 or 5 interest rate cuts this year. Now they've got down to probably 0. He's saying, no, I can see 2, maybe even 3 cuts this year, but let's run with 2. If it becomes, say, clear by September that 2 rate cuts are going to be coming in the US because inflation is coming down, well, and guess what? Stocks take off again, particularly if the Middle East is not as big a problem as we were fearing last week. So putting it all together, there's a very good argument that what we saw from October 27 last year until this negativity of recent times, that showed you that the expectation of rate cuts would generate an interest in tech stocks, in growth stocks. The overall index rose. I think the S&P 500 was up about 26-27% from October 27, driven by tech stocks and growth stocks and all that sort of stuff. So I'm arguing that if Middle East becomes less of a problem, and inflation continues to fall and rate cuts are back on the table as we get later in the year, the market takes off again. And so your question is, well, what would you invest in? And by the way, I'm not the only person saying this. A guy called Tom Lee from Fundstrat Securities, really smart guy. He's tipping that the S&P 500 could be up 13% by the end of this year. And also Jan Van Eck from the fund, Van Eck Fund, he's saying that he thinks commodities are going to do really well because he sees China on the improve. And if commodities are on the improve, that's really good for Australia. We sell commodities. And so, and BHP and Rio and Fortescue and all these sorts of companies help drive the stock market up. So there's a lot of good reason to believe that things can actually improve despite the scary nature of the stock market right now. And that's the argument that I'm putting forward, that if you want to think about investing now for what might happen in 3 or 4 or 5 months' time with potentially inflation falling, you look back at what worked 6 months ago. And so I'm thinking, well, if they want to sell CSL off and BHP and Xero and Macquarie, I'm happy to be a buyer. And I'm also happy to buy VAS, which gives you the top 300 stocks as a Vanguard ETF. Top 300 stocks. If you're a real risk taker, you can go for Gear. Gear will give you the market rise plus a magnification effect, but it is for the risk takers. Things like HNDQ, now that will give you the top 100 stocks in the NASDAQ. I reckon that will have a nice run again. And also, if you just want to buy the US stock market, S&P 500, you can buy the ETF IHVV. The H is it's hedged, because when all this stuff becomes more positive, we call it risk on in the business, the $8 is going to rise. And that's why the H part, the hedging part on AHVV makes a real lot of sense. So my argument is things will get better. Use the back to the future strategy. Look in the past to see what worked when everyone thought interest rate cuts were coming, and they will work in the future. That's my argument. That's my story. I'm sticking to it. And that's our first part of the show, which we open up for everybody who wants to check out what we're doing here. But if you want to see the second part of the show where Junbei Liu gives her special tips on the market right now, you're going to have to be a subscriber to the Switzer Report. So please go to switzerreport.com.au and become a subscriber.